Boom! And just like that, we are live, baby. Happy Thursday, everybody. Welcome back to another episode of Benzinga Live. We have a big day here on Benzinga. At 1:30, we will be interviewing the Mullen CEO live. My man, Money Mitch, will be taking the reins on that, so make sure you stay tuned to the channel and hang around for that because that will be a big interview. I've been watching Mullen's stock today, trading around right around 90 cents, down about 3%. But I mean, hey, look, this stock has up about 20% in the last week. Everyone is interested in these EV stocks. So Mullen, definitely a big interview coming up at 1:30. Excited about that one today on Benzinga Live for the next hour and 40 minutes or so. If you're hanging out with me, we've got a packed show. We've got Steve Coli joining us from Trade Easy here. In about 15 minutes or so. Steve has one of the best setups out of any traders we bring on the show, about 30 monitors behind him. Then after Steve, we will get Rob Roy right before noon, talk to Rob for a few minutes. And then at 12:30, we'll be talking to Mark Moran and Brian Hanley from Equity Animal. You guys know Mark Moran from Liquidity, is leaving Liquidity to start a new IR firm, kind of a new age IR firm aimed at retail investors, I believe. So I'm excited to talk to Brian and Mark about that, learn more about the new business they are starting over there. And then after that, we'll bring on Options Mike at 12:45. So we've got a packed show, 4 guests or so in the next hour and a half. So go ahead and smash that like. Subscribe to the channel if you haven't already. Go ahead and drop some tickers in the chat. Let me know what you guys are trading. I see Tiny Pie talking about HKD. HKD, the high flyer IPO from the past few weeks. This thing ran from about $20 to more than 1,500. Now down, I'm seeing 666 right now when I'm looking at it. So I don't know if that's a good omen or bad omen or what, but man, HKD getting destroyed today, down 40%. Sorry about that, Tiny Pie, that you're caught in that. I'm sorry I told you to buy it up there at 1,500. I really thought it was going to go to 3,000 from there, but hey, you win some, you lose some. I hope that wasn't too much of your life savings. But let's go ahead and roll that intro. Like I said, drop those tickers in the chat. Let me know what you guys are watching. Let's go ahead and start Benzinga Live.
This is Benzinga Live. Spencer Israel and producer AB. What's up, everybody? How we doing?
Someone told me buy high, sell higher.
Let's get Matt Hammond on the show to talk some IPOs. Jake Wojacek from Trend Spider. We have a
breaking news. Alrighty, y'all. So we are still in the thick of things when it comes to earnings. I've got Toyota's chart pulled up here. Toyota Motors Company down about 3% after the company reported worse than expected earnings. Jonathan in the chat still shorting Apple. He's saying, I mean, look, more power to you. You know, a lot of these things, basically, you know, whether you're looking at the biggest stocks in the market, your Apples, your Amazons, your Teslas, or just the overall indices, your SPYs, your NASDAQs, these things have been on just an incredible run the past 6 weeks or so. So I don't hate that idea. If you're just saying, okay, some of these things are getting a little overextended, I might get in here for a quick short. But at the end of the day, the trend is established, right? We're in an uptrend right now. So a stock like Apple that's historically just been super strong, I wouldn't want to stay short in that for too long. Especially because even though we've recovered pretty nicely here, and you can see on the chart, if we go back to all-time highs, 183, we're at 164 right now. So only about 12, 15% off those all-time highs. But you still have some, some significant short interest. A lot of people out there expecting another big downturn in the market. So if you have the stock hanging out kind of where it is with this increased short interest, you can get that effect of people having to come in and cover. And, I'm not saying Apple stock is going to get squeezed because it's a huge float. You know, you typically see stocks with low floats. You typically see stocks with low floats starting to get shorted, not companies like Apple, but still, even on the indices, when you have that short interest, that's what causes these kind of short-term bear market rallies. I don't even know, I'm seeing a lot of people on Twitter talking about technically we're getting close to bull market territory. If you go from the lows on the Qs or on NASDAQ, we're pretty damn close to up 20% from those lows in mid-June. I don't know, thinking about it. I don't think so. I've actually been trying to gain weight, so I'm going to take that as a compliment. Can we go full screen on me? What do you guys think? Does it look like I'm starting to get chunky? Can I get anyone? I don't know. It is what it is. I have been eating a lot of Shake Shack, which also reported earnings. Maybe we should check out Shake Shack. Shake Shack, oof. Down 8.5%. Shake Shack share slump as losses persist, revenue misses the mark. So yeah, I mean, I don't know. Shake Shack is one of those stocks. I'm not in it. I think it's always kind of been a little bit overvalued as a stock. I do like the business. Let's see. Yeah, camera adds 10 pounds. Come on now. Manny A, I think if you're the same Manny that I follow on Twitter, I think you're pretty jacked. So appreciate you. Means a lot coming from you. Chunky is cuddly. Hell yeah. Jonathan saying, I think I figured Apple out. It was a gamma squeeze into the dividend. That's my thesis. I think it starts a downtrend here pretty soon, hedging accordingly. Yeah, Shake Shack ugly. I don't know. I mean, like all these restaurant stocks had incredible runs during COVID. If you look at Shake Shack here, let me zoom out a sec so we can get the price. $78 pre-COVID. COVID crash brings us down to 30. You run all the way up to around 140, so almost double where you were pre-COVID. There are a lot of companies out here like this. What's the steak one? STKS. Yep, the One Hospitality Group. Look at this one. Pre-COVID, $5, crashes down to like less than $1, and then runs all the way up to $16. So this thing went from $5 to 16, up 300% during COVID. Now coming back down a lot. It has still not back down to its pre-COVID level. So I think you see this across the board, especially with the different kind of smaller regional restaurant public plays. You know, your Darden's, your more established national brands might look slightly different, right? You didn't have the same 200% increase during COVID. You still got above those pre-COVID levels, but now Darden's back down to right about where it was pre-COVID, pretty reasonable there. Oh, I didn't even know Shake Shack was like international like that. Philippine Shake Shack is overrated. There are better burgers. Yeah, I think for the most part, I think Shake Shack provides like a good, I mean, it's like a solid burger. It's quick. It's not gonna, I don't think, like rock anyone's socks off, but I think they're good enough to make people want to come back. I mean, we get it quite frequently here at the office. This is the first time actually since I moved up here and started working in the office that I've had one so close, and we do go quite a decent amount. I just don't know, like in terms of a business and growth. Like, does a restaurant doing well, the stock can certainly do well. Domino's is an example that I think of. DPZ. But like for me, like Shake Shack, does Shake Shack really have the potential to grow? Does the stock have the potential to appreciate like different technology or software companies out there? I really don't know. Like I'm always trying to find an Apple like to buy and to hold for a long time and see how much Apple's company grows over time. I don't know if a business like Shake Shack is really poised for growth like that, or a company like Wingstop, right? Wingstop is kind of in that same category. No, honestly, thinking about it, and again, like I said, I've been trying to gain weight, so I think I appreciate that. What I saw Nick in the chat talking about Warner Bros. Warner Bros. I mean, this has been ugly. What happened with Warner? So Warner Bros. After the they spun this off from the AT&T reverse merger thing. Let me see. Let's see what other companies report earnings tonight. Let's go to Benzinga. Let's go to our Benzinga Twitter profile. We do put this out each week. Where are? Oh, there we go. Alrighty, y'all. So these are our earnings for the week. We are here. We've gotten through all of these. Thursday pre-market. We'll talk about Alibaba, Eli Lilly, of course, Shake Shack. We talked about that. Penn National Gaming. And then after the close tonight, Nick in the chat mentioned Warner Bros. We also have Twilio, Lyft, Amgen, Beyond Meat, Expedia Group, Zillow Group, DoorDash, Dropbox, Chegg, Block, and Carvana. Now look, I mean, I've been kind of hands off playing a lot of these different earnings the past week or so after I got burned playing Snapchat a couple weeks ago. But let me know in the chat if you guys plan on playing any of these earnings coming up. I do think, right, you're seeing a lot of volatility throughout the markets, but for the most part, companies have beaten, and it seems like there's more alpha trying to play the upside on these earnings reports. Getting word from Hot Stocks Luke. There will be no Hot Stocks Luke on Benzinga Live today. He's crying about it, he says. But he will be joining us tomorrow, so make sure you tune in tomorrow for a special Friday edition of Benzinga Live with Mr. Hot Stocks Luke himself. I don't know, guys. I think this week for me, Airbnb was one of those that I was very much looking forward to. You also tomorrow, DoorDash is interesting to me. Beyond Meat, I haven't checked out Beyond Meat's chart in a while. Let's go ahead and do that because Beyond Meat has been just one of those crazy volatile stocks. Dylan, you want to whine about your Robinhood account again? We can do that. Beyond Meat. Let's check this one out. This is one of those that you look at the chart of in retrospect, and you're like, yeah, I mean that thing got crazy, but people were buying it up here. People were buying it above $200. So let's go back. This was even pre-COVID. This, thing IPO'd and just went insane all the way up above $200, crashed. Here in the chart where my cursor is right now is right around where the COVID crash is. You get down to March 2020, lows of about $40, and then this thing runs back all the way up above $200, and since has just been on a horrendous downtrend since then. So this is going back to January 2021, so more about a year and a half now. This stock has just been in a straight downtrend. I don't know. I mean, I think from a financials fundamental standpoint, this thing is such a growthy stock that hasn't even sniffed being a profitable business yet. But eventually the stock's going to be so beaten down and the expectations are going to be so low that even no matter what the company reports, that the stock may not go down that much. So I wouldn't be buying puts here just because I don't want to buy puts on a company that's already gone from 200 to 30 and the expectations have been lowered. You can see here on the chart, you've gotten some consolidation here the past couple months since May that, we never really dipped below this $22 level. We're at $32 now. But I'm not going to play this into earnings. I'm more going to watch Beyond Meat after. If you get a surprise beat and this thing spikes up from 30 to 40, I mean, you're still way below historically the levels we've been at. If you look at whatever the 200-day moving average is, I mean, we're still below that. So I don't know. I mean, I'd rather just sit on the sideline at this point and wait for some of these companies that I'm not expecting great earnings, but I also know the expectations are so low that I don't really necessarily believe that the stocks are gonna continue to crash from those earnings because the expectations are low. Yeah, and I think that's the big worry here. I think that's what the bears are looking at here, thinking about, is just that Beyond Meat's burning a lot of cash, that they're worried the company's not even gonna be around in a year or so that basically their cash burn rate is just way too high to survive. So, the bears see a stock at $30, and even though it's down from 200, they say, okay, but still from 30 to 0, that's a lot of alpha in there too. So they're still willing to play that on the short, thinking, okay, this company's in real trouble. I don't know. I mean, I haven't studied up enough on the alternative meat industry. I just know from trading and from being in the markets during COVID that you had all these stocks like Beyond Meat that got way overvalued. It's not really a surprise to me to see the stock trading down so much from those highs. All right, guys, let's go ahead. I see our first guest, Mr. Steve Kalajyian, hanging out in the background. Let's go ahead and bring Steve on in a minute here and see what Steve's been looking at. Steve from tradeeasy.com. I'll go ahead and drop that link in the chat if you want to go ahead and check it out. Steve's been on the show, coming on the show basically every week the past few weeks or so, but Steve's been spot on with his levels and whatnot. We talked about a Goldman Sachs short a few weeks ago. Before that, I believe it was a Chevron trade we were in. So I've been really enjoying having more of Steve on the show. So without further ado, let's go ahead and give Steve our special intro. Let me get my headphones on and we'll bring him on the show. Mr. Steve, how you doing this morning?
Hey, Aaron. Good morning, everybody. How are you?
I'm good. How are you?
Great morning. Great morning.
So let's hop right into it. What have you been trading today?
We had a phenomenal sell divergences on the opening in Tesla, Amazon, Roku. Look at the highs that we had. I had strategies that I wrote, and these are sell divergence strategies, and we nailed it there. Square, Roku, Amazon, Shopify, what else I say? Amazon, Tesla. The Tesla I was jumping up and down on the Tesla one. Hit above the 940 and just got absolutely kabooshed. And what else do we have here? We had Micron, Netflix, Nvidia, Meta. Oh my God, that Meta was an amazing short as well. So these sell divergences really kicked in. You had to wait a little while, but then they just pummeled 3 4. I mean, Tesla is right now around the 916, 918, dropped over $22 off the high. Meta dropped about 4. And then you're looking at like Goldman Sachs off the highs here. Boeing's down about 2.5, 3 off the high. So we had a slew of sell divergences, S&Ps and spiders. And then around about 30 minutes ago, we had a big sell correlation. We just got short the S&Ps. They dropped about 14. So I think the highs are in for the day. We had extreme overbought levels. I was praying for the 4180 level. We got up to 4170 yesterday, and then the minute hit 4170, bam, it dropped 20 handles on the S&P. So I think that we're going to make a higher low here, work off this overbought condition, get one more push up. I'm thinking maybe about the 4220, 4250. There's a ton of overhead resistance in the market. And we have 4 major gaps below the market that I think are going to get filled in the next month and a half, no more than 2. I don't know if we're going to make a new low. There's a chance, but if we do make a new low, I think it'll maybe get down to the 3450 and then shoot right back up. We printed 3642. There's a chance that they could make a double bottom. But I don't know. This is a bearish pattern that you're showing right now, right here. I think the higher they go, the harder they're going to fall.
Yeah, I mean, so you mentioned the Meta short, but I'd be curious out of the names, and I know you have a list of 30 or so names you're watching on a daily basis, but which ones to you are looking the most overextended, the most kind of setting up for short trades? Because I assume if you're talking about the S&P flushing out and coming down and being bearish, so you got to assume that means some of your big names that you're watching are going to drop.
They all have the identical same patterns, pretty much. If you look at the bigger time frame, look at that pattern on the S&P.
Meta's in the SPY's chart aren't. I mean, Meta's come down.
No, Meta has a different chart because Meta had earnings and Meta really got kabooshed down to 140 level. I mean, but look at this chart here on the spine. This is look at a ton of overhead resistance. this could be almost a double top right here. And even if it gets above that, where is it going to go? I think the risk is more to the downside than to the upside.
On Meta?
No, on the spiders.
Oh, okay.
Piece chart up.
Yeah. So okay, so you did the Meta short. You're basically saying all your names that you're looking at, the charts are pretty similar and they're all pretty bearish.
Yeah, if you look at the bigger time frames like the daily and the weekly, a lot of them have almost have the mirror image of it. I mean, that's look at that overhead resistance. It's where is it going to go here? You know, I mean, if you look, if you just take the move, if you can move your cursor right to September of last year, look at that. Two more. 21. Sorry, that's I can't see your two. Right here.
September 21, right here.
Okay, go to my left a little bit more, which maybe you're right. No, keep going over, over two more, about 6 more bars over. Okay, look at that. There's no overhead resistance here, right? Okay. So when you got moves like this, though, you're just going to go straight up. You get pullbacks, but now look at when we had the top at 4,800, and then you drop all the way to 3,600. You're going right back down here. You got a base for a while. You just can't go straight up with that overhead resistance here. It's like running into a glacier here. Whereas if you look back where I showed you, it looks like September of 2020 it might be. Go back to right there. Perfect. Yeah. Look at that. There's no overhead resistance here. You know what I'm saying? The only once you cleared this number here, wherever this was, we had right before this big candle gap down, there was no overhead resistance. Look, you had a clear sailing up, right? But now look at you. That's a different picture than what we have now. We have tons of overhead resistance, whereas over there we had no overhead resistance, and the pathway was just straight up.
Yeah, and I mean that makes sense to me that coming up from here where you have overhead resistance, we're gonna run into bumps and reject and kind of have these, downturns. But eventually over time, the markets usually clear these previous resistance and make new all-time highs. So how do you navigate, finding where we're gonna come down and then start coming back up and start clearing through some of those previous resistance points?
So I think, my personal opinion, we head lower, and I think it's going to be a staircase of making lower highs, right? And then eventually you'll get to a level where the market will just start basing. Then again, where are we with inflation? Where are we with? I mean, consumer debt's the highest it's been ever. We got 16. Well, I forget the number. Was it 16 billion? 16 trillion? 16. I don't know. I heard yesterday somebody said the consumer household spending debt was the highest ever. You have a $34 trillion deficit. We're just printing money, and hopefully our money is worth something. But the point of the matter is that you really haven't seen anything catastrophic except for what happened during COVID, during the March 20th, low, and then back in the 2008 crisis, the subprime market, so debacle. Then prior to that, we had, the long-term capital and the crash of '87. So we have long expanded periods of where we have these, catastrophic moves in the market. And I was there for a lot of them. But the point of the matter is that, here, I think that the Federal Reserve is caught between a rock and a hard place. They're caught because we had 2 negative quarters of GDP negative growth, which is a sign of a recession. And 2, you have interest rates that are, that are starting to rise. Housing, excuse me, I just started to see come down. Oil is below 89 from the high of like the 131, 134 range. So you're starting to see maybe potentially some ease there. I mean, don't forget we were up, gasoline was up 59% prior to oil dropping below 89. So now maybe it's up about 53% off of, where we were around the 230 level. Now we're about 470 on gasoline. some places, but food's still high. So the interest rates that they're rising, that they're raising, is not really doing any negative impact on bringing prices down to a major level. And people are still struggling out there, living paycheck to paycheck.
Yeah, and I mean, you got to keep in mind too. You mentioned the Fed's in a rock and a hard place here. The Jerome Powell came out last week and basically said they were going to try to stick to data dependencies to be able to look at data. And we have a lot of data coming out in the next week or so. I mean, tomorrow, a lot of people will be looking at the unemployment rate, because that has been one number. The kind of unemployment rate and jobs numbers have been the one spot people have been able to look at and say, well, okay, I mean, if we're in a recession, why have jobs numbers been all right? So, if those are poor tomorrow, I would definitely expect to see the markets, take a dump, because people that, like I said, that's been the one kind of bright spot in looking at the economic data, is saying, okay, jobs are still good. Maybe we aren't in a recession. So if that isn't true anymore, then I would expect to see the S&P and some of the major indices down tomorrow. But then next week we have CPI on Wednesday. So we're going to see, I think we're going to learn a lot more from the Fed over the next week or two, based on this data coming out.
Yeah, but the thing is, with the Federal Reserve, what they did was they started looking at data now, right? But they had data a long, long time ago, and their target was always 2% inflation. And you can't go from 2% inflation to 9% inflation and now start doing something about it. Their mandate was always 2%. That was their job, to try to always keep inflation in check. They just kept rates as near zero for a longer period of time, even when inflation was above their 2%. God bless you. And
Thank you.
when rates and when inflation got to 8.5%, 9%, then they decided to have to look in the rearview mirror. I think the Federal Reserve was hoping for the best, meaning asset prices would continue to rise to offset the rise of inflation for the end consumer. The problem is, a lot of people in the United States are not in the stock market, right? They're not balancing out the means of the rally to offset their everyday spending. If you make X amount of dollars, if you make an X amount of dollars, let's say you make a family household of $100,000, now you have 9% inflation. Now you just $9,000 is pretty much, you got to take off the top,
Right.
And that's what's
all right, Steve, we do unfortunately have to run here in a minute. We've got a little bit less time today than normal, but
No worries.
I did drop that Trade Easy link in the chat, folks, if you want to find more from Steve. I do see a good question from Jonathan in the chat. Will be our last question for the day. He's just asking, what would be a sign, a macro signal maybe to be bullish? What would that sign be for you? And maybe it's 6 months, years away. Like, I don't know, but what would that sign be for you that okay,
we want to definitely
bullish
see the CPI number coming down. That would be the most bullish thing.
Okay, well, next Wednesday we'll get that CPI number. I believe it is expected to be lower than last month's. We'll see by how much lower that ends up being.
But it's not just 1 month; it's got to be consecutive months. You know what I'm saying?
Right.
It's got to be
maybe 3 consecutive months of 3 or 4. Okay.
Yeah.
So there you go, Jonathan.
Great question.
Great. Yep, great question in the chat. We got a pretty smart chat out there, Steve.
Well, I think I'm seeing more and more people so in tune to the markets today that they look at all the economic numbers and combine that with the technical studies that I apply. It all works well. But you got to trade what you see. You just can't have an overall opinion, because the market's going to do what they want to do. And I always tell people, you got to trade what you see. And I don't come in here with any opinion, period. I just trade what you see each and every day. That's the most important thing.
Beautiful. Well, guys, like I said, if you want to check out more from Steve, visit tradeeasy.com. Steve, always a pleasure to get you on. We'll chat soon.
Thank you. Take care, Aaron. Have a great day, everybody. Thanks, Aaron.
You do the same. All right, folks. Find more from Steve at tradeeasy.com. Love getting Mr. Kalajyian on. And yeah, I mean, I agree there. 3 or 4 months of consecutive CPI, decreasing would be a very bullish sign. I see someone in the chat, Kramov, saying 1 month could be an aberration. Yeah, we already saw that. I believe it was April's CPI was lower than the previous years. And then the month after that, we ticked back up after a lot of people were thinking, oh, if we get 2 consecutive months of lower CPI, that's a sign inflation has peaked. But right now with gas prices, that's going to be the biggest thing. So if we get lower CPI for July, and then we continue to see gas prices fall, then economists will look at that and say, okay, we expect to see CPI be lower again in August as well, because gas prices would just continue to be falling from these elevated prices they're at. Speaking of, I'll go ahead and pull up just because we have been checking this site pretty much daily. I'm just been looking for the trend to stop. For basically, gas prices have been down every single day consecutively the past 50 days. I'm checking here daily to see, okay, when is that going to stop? When are we going to get a day where either the price is the same or even more than the day before, instead of it being cheaper each day? So today the average is about, we'll call it 414. Yesterday 416. So again, today gas prices lower than they were the day before. Pretty cool kind of map here. You just go to gasprices.aaa.com from AAA. You can check what state you're in, see which counties in that state have the cheapest gas. So yeah, I mean, gas prices continuing to fall. Your Chevrons, your Exxon Mobils, those stocks are a little lower after reporting great earnings. Lisa Lee still paying over $6. Sorry to hear about that. Yeah, California is kind of the one spot where, it looks like we haven't gotten as much relief, but still for, a lot of parts of California, seeing that come down. But yeah, I mean, like if you look down here in Texas, paying on average in Texas $3.64 a gallon. Certain counties have it as cheap as, $3.50 even here in Dallas. So good to see. I mean, I'm not saying it's great news that we're still having to pay this much for gas, but it's nice coming down on a daily basis. All right, guys, I do see our second guest hanging out in the background. We've got Rob Roy, tradinglikeaboss.com. If you want to check out Rob's site, maybe you'll want to hear from him, then check it out. But I'm going to drop that link in the chat now just so it's there. But Rob comes on with us. He was coming on every Tuesday. He's going to start coming on every Thursday with us for a few minutes. But Rob is one of my favorite guys to talk to because he's trading options, but not trading options in a way that a lot of people out there on, Twitter or Reddit are doing, where you might buy some kind of YOLO crazy calls and they're up a lot. Rob's options make money, don't get me wrong, but he's looking for more consistent winners to get you into a strategy that's really repeatable and consistent, rather than, okay, I just made a bunch of money then lost a bunch of money. So without further ado, let's go ahead and give Rob our special intro and bring him on the show. Mr. Roy, how are we doing today?
Aaron, how you doing, my friend?
Good.
Fantastic. So I'm getting a little light going over there. Helps a little. How's the market treating you today?
I mean, the markets are fine. I mean, I think oh wow, the Qs have actually ran up the past 20 minutes or so. To go back green on the day, I haven't really been, to be honest with you, Rob, been like trading a lot of options or anything the past couple of weeks. I've been kind of just hanging out more on the sideline.
Okay. Excellent.
How about you?
Yeah, today was a busy day. I think it's 5 or 6 trades we got off today. So today was a busy day.
All right, what should we start with?
So first one was Cigna, right? They came out with earnings today. And guys, you can go after their directional trades. You can go look for buying calls or buying puts, and nothing wrong with that. But knowing how stocks react around earnings. So if we look at Cigna as an example, okay? But knowing how stocks react around earnings, if you can go ahead and get into a trade somewhere down below this 272 level, right, on a credit spread. So you come back here and you look at the 272 bull put spreads, right? Let me just grab 272 half. Let me click on it and pull this out of the way, right? So we were looking at right around 50 cents or so on that option, right? Give or take. And then it's a bullish trade using put. So we're going to go down and use a lower put for our buy position. So now you're looking at, we got it a little bit later, but we got about 15 cents on this trade. And it's not a lot of money. but it is 15 cents with a $2.35 overall risk. So if I buy the stock, I've got a much greater risk than that, right? How far down can the stock go to zero? But you're looking at about 7 or 8%, and we're anticipating to be out of that trade today. It's already dropped in price. We sold it up front, so we got paid up front. Now we go and buy it back later for a lower cost. We did that on Cigna. Sorry, let me get my charts back here. We did that on Cigna. We did it on CROX, CLX. Right? They're another one, right? Also earnings today, right? Getting hammered, right? So they gave us a great opportunity with the bounce back up and the fail to look at a trade there. And then you had Eli Lilly is another one, right? Eli Lilly, same scenario, guys. If you could find something above this 314 level as a bear call spread, as a spread trade, not directional trade, we get a smaller rate of return, but I've got a better chance of being right. And that's what you have to ask yourself. If I told you on the trades that we do, my goal is to have an opportunity to be right somewhere around 70% of the time, is that okay if you have a much higher rate of, back it up, a much higher chance of being right than trying to chase after the higher rate of return? I mean, to me, that's the way to trade is consistent. I'm not trying to hit home runs. I'll get them once in a while, but I'm not trying to hit home runs. I want to get on base over and over and over again.
Yeah, and that's what I was mentioning before you hopped on, why I like learning options from you and what you have to say about options, because we all, or not, I shouldn't say we all, but, a lot of us and a lot of people that have kind of learned about investing and trading in the past year and a half or so see options as this, really risky way to potentially make a lot of money or lose a lot of money really quickly. And you're kind of taking that and saying, yeah, that's one way to do it. But here's this other way that, can actually be a way to help supplement your income, or maybe, whatever your goals are, that this way is a way that you're not essentially just going to the casino every day.
Exactly. And with options, you don't need a lot of money. You're going after Eli Lilly here, $300 stock, right? You buy one share, you're spending $300. What are you hoping for? A $5 move, a $10 move to make $5 or $10? You buy 10 shares, it's $3,000. You buy 100 shares, it's $30,000. Well, I can buy, if I am a directional trader, let me just change this chart over to Lilly. As a directional trader, if I think Lilly's going down, which from their earnings, it sure seems that way. But if I think they're going down, and even if I want to go out for a whole month of time, if I don't want to day trade, let's go be crazy first, and we'll go out 29 days from now, I can buy an option for $20. That means one contract would be $20 times 100. So what is that? $2,000, right? $2,000 to control 100 shares of Eli Lilly. And that's for the next 29 days. If I think I want to look for a trade this week, right? And I come over here and I look for my delta of 65 to 85. I've got an 86 delta, a little higher than I want, but 1,181 open interest, 435 volume. That means that's how many contracts traded today. I can buy this for $5.50, $5.35 right now. So I can control one contract or 100 shares of Eli Lilly through this Friday for $535. I don't need a lot of money. I don't need to have a lot of contracts. I'm not buying lots of shares. We do comparisons all the time of what would it take. I mean, guys, what would it take here? And the numbers really don't matter right now, but you got a PayPal, right? What would it take to control, it's 10 contracts we did of PayPal on an option versus having to buy 1,000 shares? Because that's what it works out to be, is 1,000 shares. I mean, you take 1,000 shares. I know y'all probably can figure this out, but $88 a share, you need 88 grand. To do this with a day trade for an option, I need, $6,000, $7,000, $8,000 if you're getting crazy. All right. It all comes down to what is your goal in the market. If your goal is to hit home runs, I'm probably not the guy. I'll get some. Don't get me wrong. We had a $52,000 booking trade not long ago. We'll hit some home runs. but I'm not trying to hit home runs. If I get on base consistently, right, you have to ask yourself, what are you trying to accomplish with your trade? What's the goal? What is your why?
Yeah, I mean, so wait, did you guys have a booking trade going into the company's earnings yesterday?
No, we did not. We waited until after we took a trade on booking today. We waited until after the earnings. The one we did on booking, again, these are all for education, right, guys? So here's a booking trade that we did on July 29th. That was $5,000, right? Come on now, there it is. I don't need to look for the symbol. I just look for the dollar amount. There's the booking trade on June 28th was the entry. July 18th was our last exit for $52,000. It's one of our bigger trades this year, right? You can see, guys, I'm not trying to hit home runs, right? There's $24,000 on booking here, right? We lost $15,000 on Amazon. That's because we held it overnight. Had we exited the same day, we would have been up like $35,000. Instead, we held it overnight and we dropped 15. So no, but we did not, Aaron, have one going overnight. I don't hold into the earnings on my option trades.
Yeah, I thought so. But I know last week we discussed kind of how you can trade options on the futures by waiting for when the company's earnings reports come out and then trade the futures based on that. Have you been doing that this week?
I did not. None that I did this week. For me, most of them are gone already. It's Amazon, Google, Tesla. Those are the ones, the big NASDAQ stocks, Netflix, the big NASDAQ stocks are the ones that tend to move them. I do about a half a dozen stocks. One of our students, Trip, he tracks about 80 that he does utilizing this same method. And all you're doing, folks, is you're watching the announcement of the earnings after the market closes, and you see it's going up, it's going down, and we're going to either buy or sell, both of them to open. We're going to buy to open or sell to open the NQ, which is the NASDAQ futures. That's it. And you're going to follow that path. It's a short trade. You're in and out in a couple of minutes. Most work, some are going to slap you, but you tend to do okay if you're holding on to and going after the right stocks.
I love that. All right. Well, if you have any other tickers or charts you want to look at, let's pop them up. Otherwise, let me ask the chat and see if they've got any stocks they want to check out.
Yeah, we can do both. You can pull questions. I can look at some for tomorrow that I'm looking at because I'm not looking at anything else today. I mean, Mastercard was our biggest mover today, right? So we had a nice reset on Mastercard. So guys, if you see, and again, this is not me just saying, well, Mastercard seems good, let's Reddit it and throw some money at it. There's a time and a place for that and a reason that you put money like that into a trade. This is, we have a plan, all right? We broke above yesterday and closed above this fib line, which is the 764. The 764 level is a hesitation level. Right now, that number, if you're following someone else that uses fibs, they're using a 786. I've modified mine 25 years ago to 764, and it gave me an absolute confluence with the 236. 764 is not hit very often, but we broke above. Today, we came down and retested. So that's the 353.05 level, right? So we don't just say, well, it tested, so we took the trade. Let's go look at Mastercard and see how it actually aligned. So right down here is that 353.05 level. That's this bottom line, right? So I'll bring it in now, and let's look at what happened. On the open, we opened kind of flattish, and but that wasn't very long. It dropped quick. I'm looking back on my daily chart for a bullish move. I'm not wanting to trade bearish. So anything that's happening bearish, I'm back here, position number 1 in the chair. I don't care. Excuse me. I'm waiting for the stock to move from Mastercard to move back above. On a close, it closed above. It came back on the next candle. So this was on the 10:15 closing candle. It closed above for the first time today. It came back and retested at 10:20 and bounced. So when the stock was at about 354 or so, we entered the trade. Excuse me. And now the stock is sitting at 357. The option has about a 70 delta, which means for every dollar the stock moves, the option moves 70 cents, which means your stock is going to move $3, your option is going to move $2. but I did not need $300+ per share. I only needed $7 or $8 per share to trade this fantastic move. And we called this trade last night in what we call our power option plays. This was one of the setups that I gave last evening of what we're looking for on Mastercard. We called it for a day trade. We got the exact setup that we're looking for today, and pull the trigger now and you're up, $2 per share, $200 per contract, or the equivalent of about 25 to 35%, depending on where you got in.
Wow. And to me, so Mastercard, to me, at least in my mind, is one of those stocks that doesn't move a lot. What was like your signal here that this would be a good trade?
So I never know if it's going to be. Think about that. We find the highest probability setup, and once the setup presents itself, we take the entry. And the reason for the taking the entry, Aaron, is if you've gone through and traded your system from a back testing standpoint, where you've actually gone back historically and looked at the setup to see what it does, from a forward testing non-funded setup, and then from a funded setup that you've now put real monies into the trade, you've built a tremendous amount of confidence in your trade setup. Too many traders are chasing after that bigger, better setup, right? Where they heard me talk or somebody else talk or the next guy talk, and they go into that trade setup because I show numbers and show what our setup has done, and they do 3 trades, and it just happened to be a bad day, a bad week, a bad month, and it didn't work. So, this doesn't work, and they give up and they go to the next setup. This is the course of thousands of trades that we've done with the Mastercards of the world, but basically the majority of what's in the higher price stocks in the S&P 500. And when we look at Mastercard, I understand they may not move very much, but Aaron, would it surprise you to know they move $9 a day from high to low?
That would surprise me, yeah.
That's what it's called Wilder's average true range. And if I take it back to the previous template, I can see it on this sidebar here. But if you look down at the bottom here, it shows Wilder's average true range, right? $9.19. That is a per day move over the last 13 days average. They move $9.19 a day. Remember, I want to take out of this trade. I'm not looking for the home run. Think of the entire trade as a hamburger. The entire move is a hamburger, right? On the bottom, you've got a bun. On the top, you've got a bun. In the middle, you've got the meat. Don't eat the bread. It's no good for you anyway, right? All we want to do is take a little piece of meat out of the middle. That's what we want to get out of this trade, and that's where this setup took us.
So Dylan Carson's asking a good question in the chat. He's wondering, can you share how to find a trade as opposed to how to actually trade it? So maybe when you're doing screeners or whatever you're doing here, trying to find which trades to make versus actually, putting that trade on and
sure.
Entry and exit points.
Good question. I have a list, guys. I'll share with you. It's not like I hide it. It's not a secret list. It's not like you guys don't know who these stocks are. Let me just find the list itself. There we go. So Apple, Adobe, Amazon, and so forth on the left side of the screen. When it came to Mastercard, as an example, last night, here's what I was looking at. Right? Mastercard was in a position last evening. I'll bring this in so I make it as big as I can. Right? Mastercard closed in a position last night that we got right above this Fibonacci level, this 764 level. Okay. We have played with that line 1, 2, 3, 4 out of the last 5 days. We played with that line. Yesterday, we closed above. Right. So now we're in a great position. If we were here and I was sitting here at night going through and doing my analysis, this is where I would be. Let me get the mouse out of the way. This is where I would be. I'm in position 1 in the chair. I don't care. There's nothing there that says take this trade. Last night, I start off and I'm sitting here and I went, oh, wait a second. And now I'm in position 2. I'm sitting upright in my chair. I'm very focused on what's going on because we closed above that moving average. I mean, that fib line. So what am I looking for now? I transfer this 0.764 fib line, which is the 350, 305. I transfer that to my intraday chart. Right here, 350, 305. And now I wait. First candle of the day, right here. I'm sitting back here in my chair. I don't care because I'm looking for a bullish trade, and that candle is not giving it to me. And until we can close in a bullish position, just away from the bar, though. I don't want it to close at 353.06, right? I just wanted to give a little bit of room above, get up there a little. You know, we're at 353.5, so about 50 cents higher. So at this candle right here, this red one, Aaron, I'm still in position 1 in the chair. The candle that closed above that 353 line right here, that drives me to position number 2. And I'm waiting now. The trade is loaded. My option chain is up. I already have loaded up the trade setup that I want to do, whatever that is. And whether it's a credit spread, whether it is a diagonal spread, whether it's just a directional call or put. And when we came back and retested on this 353.05 and bounced, right? And we waited until it got to about 354 is about where we were in. So it was on this candle is where we took the trade. We just want to make sure we got enough movement off of that 353 that it wasn't just a little head fake and we were dancing around that level. And that's the finding of the trade, Aaron. It's every step that we do, every step that I teach, everything we go through in our power option plays where I teach this and call these out on, I mean, here's my sheet, guys. This is the sheet, the tracking sheet. It's nothing special, right? It has the symbols, which I just shared with you, my bias, my bullish and bearish targets, earnings, and what our note is. Here, you know what? I'm sure even if you could see it, you probably can't read it. So let me do this. Let me find this page here. And I'm just going to go back to a previous one. So here is the sheet for, and this is back on July 18th, right? Here's the sheet back on July 18th. Go check some of these out, guys, and see how they did. This was a day trade, right? All the details are given inside of the training. Here's Amazon had earnings coming up, right? Here was our open trade on Booking, that $52,000 trade. Here was an open trade on NVIDIA, right? We're also going to have ones. Let's see. So here, bullish with the pullback to the 8 aggressive. On Netflix, bullish with the pullback to the 8 aggressive. Aggressive just means we're only taking 4 contracts. Our normal trade is 10. If there are certain reasons why we pull it as aggressive, a lot of it has to do with what's called bias of our moving averages. But this is it. There's targets both up and down. So if you're going to day trade it, you've got targets of where it goes. If you're swing trading it, you've got longer term targets to use as well, right? And there's how it all lays out. Everything we do is all about a step-by-step process that works. Aaron, maybe I'm unique in this way. I don't think so. But if you're trying to do something, wouldn't you prefer to have every step just kind of laid out for you instead of having to guess what to do?
Yeah, like if you're reading an instruction manual for putting together an IKEA or something, you want the step-by-step.
But that doesn't happen in IKEA, I don't think. But anyway, we're on the right page. Yes, I agree. So you want that step-by-step of what to do. That's what this is. If A happens, then do B. Bullish with the pullback to the 8 aggressive. What does that mean? I need a pullback to the 8, close near the 8, bounce off of the 8, and then we can take an aggressive trade, which means 4 or less contracts in that trade. And most of the traders that follow what we do are trading 1 contract only.
Got it.
Trading 10 or 4. They're trading 1.
Yeah, and I like the fact, I think, I think having this list of stocks, right? If you're a trader out there and you want to track your performance, you want to track what you're doing, like Rob's doing here in a spreadsheet, having a list of 20, 30 or so stocks you're trading is going to allow you, I think, to have better success than if you're trying to trade 100 different stocks, or, you wake up that day and people are talking about this stock you've never heard of. You're probably not going to be as comfortable trading that stock you've never heard of, rather than like something like an Apple or Amazon, something on your list that maybe you're looking at every day. And then you get to understand, you get familiar with that stock's behavior.
Correct. It's my process is unique to me, but every successful trader, ones that are in my own mastermind groups, the one which are masterminds that I am a member of, ones that are in mastermind in my inner circle that are students of mine, every successful trader in there has their process of what they do to identify a candidate. And it's 4 words: identify, enter, manage, exit. You've got to have a rule for all of them. If you don't, then you're going to fail. It's not might, it's not can, you will. You may get lucky, you may get some that work, but sooner or later, you're going to get your head handed to you if you don't have a plan for all of those phrases. How do you identify the candidate? What is your entry signal? What's your management technique? And ultimately, what makes you exit out of that trade if something was not going the way that you thought it should?
Yep. Rob, do you mind pulling your charts back up? I do want to take a look at coin right now because coins, it had some increased volatility. You had that news with BlackRock this morning. But the stock is now up just in the last 5 trading days alone, almost 60%. So I've had a lot of people in the audience and whatnot, basically say, oh, Aaron, I'm going to go out there and buy some puts. This stock's up 60% in a week. And I'm like, well, it is, but I don't know if that means you want to buy puts. What do you think?
Well, so again, I do it by the technicals. Here's the way I want you guys to think about that. If you're looking at that saying, is this a place that I go buy some puts to just try to pick up some quick cash? Let's pretend you want to put $500 into that put trade. Here's the way I want you to think about it. If you're willing to tell me that you will go to the top of the tallest mountain wherever you live, take $500 and $100 bills in your fingertips and let it go, then by all means trade puts on this just because you think it's gotten too overvalued. If you're not, then you're not willing to take on that risk, because look at what happened today with that move up. How many people got whipsawed of trying to take a trade inside of there? They were bullish as it got up here and snapped down. It bounced off of the fib line. So for me, it wouldn't be buying puts until we get a close somewhere, a retest and a fail. So, and I wanted you to see the entire fib because it has been a hot topic lately, right? But there's the entire Fibonacci, right? Up here from 200 all the way down here to 45 or so, right? We got this gap up today, right? We stretched higher and we failed. So now what I'm looking for, Aaron, for me to take a bearish trade on this is I want to see the stock make a move back up to this fib line, close near it, and that could be today, close near it and fail. There is one line missing in here. We need to get a 100-point level inside of here, but fail off of that level. That would be the entry for me. So could I miss out on the trade? Yep, without a doubt. Has it happened before? Numerous times where I miss out because I wait for the setup, but I have a higher probability of being right, which means my risk is lower in that trade. My profit may not be as high, right? If I got it early and I was in there, man, and I rocked it. I took the whole Amazon move, from the lowest low near 100 all the way up to 135. That's great if that were you. That's not me. I'd be happy getting Amazon at 112, selling it at 120, 122. I'd be tickled pink, right? I'm not trying to trade off of this. The risk is a little too high for me on an Aaron without a reason. What compelling reason is there to take this trade? Because it's done something that's unconventional. And I'm not saying it doesn't work, but for me, the risk doesn't allow me to sleep at night.
Yeah, and I will say that's what I guess the one upside, if you were just looking out here trying to buy puts on Coinbase, is you can do so knowing your exact risk, right? If you want to risk $200 buying puts on Coinbase, okay, you can do that. Now your risk is defined. If it goes down a lot, maybe you make some money. If it doesn't, okay, you knew your risk going in. So I see Henry in the chat talking about puts that paid this morning. Good job out there. Anyone else looking at any Coinbase options or any trades in the chat, let us know here.
So if you look at when Coinbase got down to about $100, when it broke 100 today, right? So let's look at it right about this 1010 candle, okay? And I don't know how the options did, but let's see. So if you look at put options for this week, because I would be day trading it, okay? So let's see. So we've got tons of open interest here. So let's go ahead and look at that put option at 10 o'clock this morning. All right. Let's see. It didn't register. All right. There we go. Okay. So if we go look at that put option at 10 o'clock this morning, right? So right about there, that option, opened up at, we said at 10 o'clock, right? So it was somewhere between $8 and $9, let's call it, in there. And right now it's at 745. But look what's happened to this option, Aaron. And this is the option itself. It's gone sideways in price. Was there a quick little move in there for someone to make some money? Absolutely. But if we're talking buying puts, you're waiting for it to fail, right? There was the fail below 100 to me, right? And I didn't pick 100 just for the sake of it. I've got a 100-point level drawn on every chart, 100, 200, 300. If it's there, we're putting a line on it, okay? So we got below there. So what if instead of this, what if we went back and we did a credit spread? And I'm going to load this. Well, I can't load it. I've got to look at what it was first. So we're going to look at a credit spread, a bear call spread, so somewhere above $100, which means we're going to look at the 105s. All right, will be the first one we do. The 105s right about 10 o'clock. If we go with the opening price at 10 o'clock, it was $4.30 for the 100s. All right, so let me just write it down. $100 calls were $4.30 at 10 o'clock. 4.30. Right? Now let's go and find the strike higher than that $100. What do we have? We had 105s, right? Not 100s. We had 105s. That was a 105 call, right? So now let's go to the 110s and let's look at the same time frame at 10 o'clock. Right? And the option was $3 and we'll call it 20 cents. So the 110s were $3.20. So Aaron, 4.30 is what we would have gotten paid. 3.20 is what we would have spent. So we're up $1.10. Now, that's what we got paid to do this trade. My maximum risk in that trade is $5, the difference of the two strike prices. We got $1.10 out of that, which gives me just about 25%. If we look at this setup right now and we look at the 105 110s, we got $1.20 right now. They're at 93 cents. So if you bought your option for $8 and that option has gone sideways, nothing's happened with it, value is going to drop if the stock is going sideways. With my options here, if I did this credit spread trade and the stock goes sideways, the options are going to devalue. They're going to depreciate, but you're going to make money on this trade. If you want to take that higher risk trade, protect your risk. Go ahead and utilize a credit spread where the worst thing that can happen to you is the difference of the two strikes minus the credit, meaning they paid you for it and you're using a technical reason to take the trade. We broke a key level, 100. We're looking for that trade above the 100, which means it's got to break through a key level again, the opposite direction to go against you. Aaron, does that kind of make sense? I know it's a lot in one.
Yeah, it makes sense to me. If anyone out there, you may need to, feel free to go back and rewind, 5 minutes or so and listen to that again to make sure you get it, because that is some great information from Rob. So Rob, I'm going to go ahead and drop that link in the chat, tradinglikeaboss.com. I'm going to go ahead and give the chat a few moments here. If you have any, stocks or charts you want us to check out with Rob before he heads out for the day, please do so now. If not, go ahead and check that tradinglikeaboss.com to get some more information from Rob, because like I said, I mean, there's a lot of people out there you can go to that will try to sell you some crazy options picks that are going to give you 1,000%. No, that's not what this is. This is how to consistently win, make real money, supplement your income trading options. Rob's your guy.
Yeah, guys, this was last week between Thursday and Friday. We're up $8,000 between Thursday and Friday. We did 10 contracts. If you would have only done one, you'd be up $800. You may look at this and go, oh my God, is it really worth it? I don't know. Is it? To me, it is. We still have 2 open trades on Google and Netflix, so we haven't closed anything out on yet either. Right? But this was Thursday and Friday last week. Right there. I just went over these last night with our students. We, went through all the trades we did, and there they are. Right? And if you want to learn more about these things that we do here, guys, when you go to that tradinglikeaboss.com, all of this training is free. Go to this 30 days of trading success. That right there will be your key. It's a free training. It's about an hour and a quarter long. Go through that, and you're going to see everything that we do. All the trades I'm talking about here, we go through those same types of trades in this training.
Beautiful. All right, Rob, well, always a pleasure to have you on the show. I hope you enjoy the rest of your Thursday and have a good weekend, and we'll see you next week.
All right, Aaron. Appreciate it. Thanks. Take care, folks.
Peace and love. All right, guys, that was Rob Roy. Go to tradinglikeaboss.com to get more from Rob. You guys need some more from Rob. I can tell by the way your accounts are looking. Just kidding. I can't see your portfolio accounts. And I hope they're all green because I know mine certainly is not today. I see Aaron in the chat. First of all, I love your name. You could spell it a little bit better, though. You need 2 A's instead of 2 R's. But David will be on at about 1:30. We're going to be interviewing Mullen's CEO. That's ticker MULN at 1:30. Money Mitch will be handling that, so I'm real excited for that interview. This stream will automatically redirect you to the next stream at 1 p.m. Stock Market Movers with Money Mitch, and then at 1:30 is when that interview will actually take place. So all eyes will be on that. Definitely an interview I'm looking forward to. So just a quick rundown for the rest of the show today. Here in about 5 minutes, I just saw our next guest hop backstage. I'm excited for this one. Our good friend Mark Moran, formerly at Liquidity, is starting a new venture, Equity Animal, a new IR firm, kind of a new age IR firm. IR has been done pretty much the same way for many, many years. So it's exciting to see someone shake things up, do things differently. Mark Moran and Brian Hanley will join us in 5 minutes at 12:30 to discuss that. See what we can expect from Equity Animal going forward and kind of what the idea is there. And then at 12:45, Options Mike Passani will join us to talk some of the options trades he's been making. We, of course, will talk some Coinbase again. While we're here, let's do a quick checkup on the overall market. As you can see, I still got those gas prices pulled up here, but let's go back to Benzinga Pro. While Rob Roy was on with us, we did get some positive momentum in the Qs. Let's see if we've held that. Looks like SPY's in the green, but I mean, I don't even know if we can call that in the green. That's pretty damn flat, if you ask me. Qs, yep, up about 0.25% right here. Let's go down to the 5-minute chart, see what we're doing. So basically no movement on the Qs. Kind of had that drop down for a little bit. Traded down here, popped back up. So I'll let you guys know if we've got any big headlines moving the markets right now. But for the most part, most people are on the sideline waiting tomorrow. We will get that jobs report before the market. And then, of course, next Wednesday, CPI. So some more economic data coming out in the next week or so before we get the next, no FOMC in August. We will have that Jackson Hole event. But I think a lot of this data coming out both tomorrow and next Wednesday will be important for the Fed in determining what it's going to do moving forward. All right, some out of stock and finance, some sports news. Not really sports news, but a sports headline that I saw last night. Something I didn't expect to see in the headlines this week. At least I did not have it on my bingo card for things I expected to see in the headlines in the first week of August here in 2022. That is ayahuasca. I don't know if you guys saw this or why ayahuasca was in the news last night, but I'm going to go ahead and tell you why and get this pulled up. And there was a lot of speculation about this. And this, again, I'm giving you a hint in the sports world. Give the chat here a few minutes because we do have a slight delay. Go ahead and get my reading glasses back on for this. It's an important article here. Coming from only the most prestigious, illustrious sources, that would be TMZ. Aaron Rodgers, he's getting deep into the psychedelics. And you might wonder why I'm talking about this. We do have our cannabis psychedelics conference coming. All right. Best adult dating site. If you want to check that out, you got to do it right now because I'm blocking that account so they can't chat anymore. So again, if you want to check that out, do it right now because they're about to not be around anymore in the chat. So we're about to have our cannabis and psychedelic conference here in September in Chicago. So we've had a few different psychedelics companies on the show. You have some different public companies that are biotechs developing different drugs, whether it's through ketamine, whether it's through MDMA or psilocybin, the drug that's found within, magic mushrooms. It's getting more and more, just accepted. Right? If you think about weed, if you think about marijuana, like 10 years ago, I couldn't imagine just walking into a store and buying a joint legally, but now you can, and that's happened pretty quickly. And with psychedelics, it's interesting because it's actually we cover them, right? Our same writers that cover the cannabis stocks cover the psychedelic stocks, but they're really completely different industries if you think about it, because everyone investing in the psych space isn't really doing so for the recreational aspect. It's all through the biotech, medical avenue, and then you have the benefit of being FDA, approved and whatnot. So you have, those certain investor benefits of investing in something that is legal through the FDA and regulated versus for marijuana right now, you have all these stocks that are doing recreational weed, but it's still federally illegal, which is actually blocking certain funds from coming in. So it's weird to think about, because I think in most people's head, you'd think, the psychedelic stuff would be more severely regulated, more intense, but really it's kind of the opposite. It's the other way around in investing, because all of that is done through the biotech FDA route and not the recreational, way that weed is going. Aaron Rodgers' new tattoo. Yeah, I think they said he got like a DMT tattoo. I don't know if that means it's a tattoo of DMT or if it's just a tattoo he got while on DMT. Either way, I certainly don't have any DMT tattoos. All right. It is 12:30. That means it is time to bring on our next guest. Like I said, we will be bringing on Mark Moran and Brian Hanley. I would tell you guys more about Equity Animal, but it's pretty damn new. So why don't we just learn more about it straight from them? Without further ado, let's give Mark and Brian our very special Benzinga intro and bring them on the show. Brian, Mark, good afternoon.
Good afternoon. Great to see you.
Good to have you back on the show, Mark. Brian, I believe this is your first time, so we had to give you the very special Benzinga Live welcome. Congratulations for making it on Benzinga Live for the first time. I don't know where this ranks in your, Mount Rushmore of lifetime accomplishments, but I imagine it's pretty high up there.
Top. It's the top. Thank you for having me. It's great to be here. Hello, Benzinga Nation.
Yeah, Zinger Nation, give Brian and Mark a proper welcome. I'll drop their Twitters in the chat if you want to go ahead and give them a follow there. But let's hop right into it. So Brian, Mark, I don't know who wants to take this, but what really, I guess we'll start with this. What was the impetus to start Equity Animal, to start a new IR firm?
Sure. So I guess the impetus to start goes back to the rise of the retail investor back in 2021. And when I came back from F-Boy Island, started working with liquidity, we started to see really the whole macro environment change, and that companies weren't really able to target retail investors at all. Traditionally through normal investor relations, which is a very state industry, there's been no development there over the past 2-3 decades. You're only talking to institutions, but then you look at the rise of Wall Street Bets, of AMC, of GameStop, all of these, then you really see that, retail plays a strong role in terms of every company. And that for corporations and executives to be able to communicate with them, no one has really ventured into that world to combine social media outreach to retail as well as traditional IR services. So we launched this week. We're calling ourselves Equity Animal, and we're going to be taking a very aggressive and new age approach to investor relations.
And I love that, because to me, I don't know, I kind of mentioned this before y'all hopped on, but it seems like to me, IR has kind of been done the same way for the past 20, 30, years or whatever. And now you have this whole new swath of investors, a whole new, really like population of investors, and no one targeting those through IR. So maybe real quick, Mark and Brian, because I don't know really how much of our audience is familiar with the IR industry or how that works. Can you talk about kind of what maybe a more traditional IR firm, does and what they do in today's world?
Yeah, for sure. I can take that one. So, when we look at the investor relations category as it exists today, I think what we see is something very similar to what we see from my experience in the advertising industry. My background before starting Bullish Studio and now Equity Animal, I worked at Vice Media. And then before that, I was at a large ad agency that was owned by Publicis. So when we see these, when we look at the IR category, there are a couple of kind of key players in the industry, ICR being one of the big ones. And they just came out, I think that they were doing 200 million in revenue a year. And they're very public with all of their, all their services and all their, what they offer. And, we just, as we did a competitive analysis, we realized quite quickly that these agencies are just, helping essentially distribute press releases and set up the 1-800 number, file some SEC filings, which obviously is very important work. And we definitely, encourage all of that, but it's really, they're offering the bare bones to just, check the boxes for the SEC and also just to, pander to the same kind of, institutional investors that they keep pandering to every quarter, every month, every, year during their investor conferences. So, they're really, it was funny. I was taking a look yesterday and I was trying to figure out who the biggest IR firms are on Twitter. And I think I found a few that are in the kind of couple single digit thousands of followers, but we're hoping to be very quickly the most followed and engaged with IR communications firm that's out there. So the industry's ripe, and I think a lot of our competitors are just they're just stuck doing what they've seen work and chugging along, and it's time for a new player in town.
Yeah, and one thing I'll add too is the average public company spends about $800,000 a year on IR. And traditionally, IR has been a cost center for these companies, that it's separate from marketing, it's separate from various other forms of outreach. In fact, in the industry, the most kind of recent innovation was in 1991, when Marvel took their 1991 annual report and made it into a comic book, which is pretty great because the individual who has handled RCI Hospitality's IR, his name's Gary Fisherman, he actually did this innovation. And so he's been working with us, and we recently did for RCI their Q2 earnings call on Twitter Spaces, which had over 4,000 people at the time. And then with you, we hosted the Bulls versus Bears debate for them, which had about 6,000 during the 2-hour-long call. Then there were over 10,000 listens afterwards. So we really see there's a way to, Brian said competition for this. I don't really view it as competition because we're approaching this in a different way because no one has really embraced the retail investor yet. So that's what we're here to do. And then the other thing I want to add is I've just been following along in the chat, and I think we need to get you in F-Boy Island season 3 is what people want.
I mean, Mark, I've seen the clips of you on there. I don't know if I could live up to that. But I mean, hey, there's no opportunity I won't at least hear out. I'll say that. But yeah, I was going to say, when Brian was giving his explanation about what traditional IR firms do and have done, it's like, yeah, the most, kind of innovative and ambitious ones, I was going to say, maybe they'll throw in some cool graphics on the investor deck. And it's like your example of the Marvel one is actually a perfect example of that, like actual innovation of that investor deck. But it seems like to me, like when I'm looking at IR, that's what a lot of them are doing. Like Brian said, the behind the scenes stuff. And then, really helping prepare the decks and whatnot. So these things, Mark, like you mentioned, like having the, earnings call on Twitter Space, having the bull versus bear debate on Twitter Space, which, by the way, we got to do another one soon because I picked up a decent amount of followers from that.
Nice.
And it was very low effort for me. I don't think I talked a lot in the space. So I just sat there and got to like reap some of the rewards without having to do a lot of the work, and so we should do that again.
Exactly. Hey, the spaces are key to growing the following. All we had to do was worry about hitting the mute button on a few people, so it was a good experience.
It did get a little heated, but that's what you need in a bull versus bear debate. I know I mentioned to you beforehand, I was like, I hope we get some kind of contentious, icon versus act, and then people started saying that like while we were doing it, people were bringing that up, so it was exactly that. But are there other ideas or things like that, like hosting an earnings call on Twitter Space that, kind of in 2022 we can do to help connect public companies with those retail investors?
Yeah, for sure. Great question. And I think there's two components to that, I would say. The first is really expanding the reach of these companies, and their investor relations division. And I think when you look at Eric from RCI, the CEO and president of RCI Hospitality, Rick, he recently joined Twitter and just became a fan favorite. And if you look at how he's been able to grow his following, those are new retail institutional investors, people that are curious about the company. And with the network of creators that we have that are on Twitter Spaces every day, that are on Twitter and that are on Instagram, we really understand the social media and how to grow, and that's essentially what we're offering, as a service to our clients. And then on the other side of it, something that we think is really exciting is the potential opportunity to integrate directly within brokerage accounts. There's been a huge burst of these kind of fintech apps that act as layers on top of brokerage accounts that you guys have covered extensively. There's folks like Common Stock and Public has been doing a lot of this as well. But we see a really unique opportunity to kind of further connect the investors with the companies, and especially if you're a consumer-facing company, a la McDonald's, McDonald's should be able to have a clear understanding of every single investor in the company, down to integrating that into their loyalty program. So if you're a top shareholder in McDonald's, you're getting a discount via their app, and we see a lot of opportunity to really merge the marketing and loyalty function together with the investor relations division, and you're seeing that obviously with Robinhood buying Say. Elon and Tesla have been making a big push to embrace more of a community voting mechanism on earnings calls. So we really want to be at the forefront of all of the technical innovations that are happening. We're in talks with folks like Plaid and others to really figure out what is the best way to do this. So not only are we really able to help expand the reach of the investor relations departments, but we're also able to help drive long-term loyalty amongst the shareholders and customers. Because they really feel like they're being treated, as one person rather than two different people from a marketing and an IR standpoint.
And I think a few other things to add too. So this network of creators that we have, we're able to reach 35 million investors monthly, both institutional and retail, which is very unique for any IR firm. So for us, we're going to be offering all the traditional services that a regular IR firm does, including outreach to institutions. And actually, based off our RIC work, we had a few institutions invest there because of that. So it's something that, really we're talking about the retail outreach, but all the traditional institutional outreach is going to be there. And it's something that for these companies, a lot of the ones that we have started off working with, we have a few publicly traded clients and a few private investment companies already. And so for them, some of them face very tough issues, especially when it comes to ESG. And we see this as something that, ESG is controlled and the viewpoints are controlled by very few people. And it's something like you see Tesla getting, knocked off of, the top 10 for these, which is just wild. But it's something that we see power in also allowing for these firms to tell their stories. And oftentimes they have tough, complicated stories to tell, but we're here to do that and to really take a different approach of, actually showcasing what the business is versus what you might think it is based off your initial perception alone.
Got it. Yeah, and Mark, I have seen that you've quickly become, ESG Twitter's favorite personality out there.
They love it. They can't get enough.
But yeah, and I think now, like with what you guys are saying, like IR, especially in terms of IR, or I should just say, retail investors have had such a spotlight over the past 2 years that now you can really kind of go to companies and say, okay, maybe 20 years ago, you were fine overlooking the retail investor and only worrying about appealing to institutional investors. But I mean, whether you're looking at something like GameStop or whatever, it's like, do you really want to, just brush off these retail investors, or do you want to, appeal to them and try to get them to understand why your company is so great or why you think it's so great, whatever it is. But another thing I love that you guys mentioned is the perks for shareholders. I know there's a couple companies doing that. There's one company specifically that's like trying to help companies set that up. But to me, that's just like a no-brainer. Like, you brought up McDonald's, so we'll stick with that example. If McDonald's said, okay, every single shareholder, whether you own 1 share of McDonald's or 10, you got a free medium fries every time you came to McDonald's, like, that's not going to cost McDonald's anything in the long run. And then, a share of McDonald's is like $200. People go buy a share. Then now they feel like, okay, I have money invested in McDonald's. I'm going to go there again for lunch today or whatever. Like, I think that have a very positive impact on the business for a relatively low cost. So I think the shareholder perks is something that can really help retail investors like feel connected to that company.
Exactly. And there's a lot of proven research in that it will boost loyalty retention rates and brand affinity, and it strengthens it. So that's part of the our pitch to the CFOs and the investor relations teams are that look, we're building long-term loyalty here. You're going to hopefully get a short-term return, but ultimately, like, we want to build long-term strong relationships with your investors, and that'll pay off in the long run.
And another thing too is for the retail investor, they've never had any power. Historically, there are two proxy advisory firms that give guidance on how every institution should vote. And for 99% of the time, all of these institutions are going to be voting, whether it's pay for the CEO, some ESG thing, all of this, right? The retail investor has never had a voice. And so we view this kind of as a two-way street. That by being tapped into FinTwit, to the retail community, and amongst all the other channels, we're able to actually gather that and help advise companies on how to deal with that rather than just reacting to that.
Yep, 100%. All right, so I'm gonna ask you guys a question. I'm gonna play as if I were dumb, because I don't think this, but like if I were a dumb person, maybe I would think like this, and you guys will be able to set me straight. So say I'm thinking, okay, people out there on Wall Street spend a lot of money, spend a lot of time doing equity research, trying to find companies that are great value. Like, and again, I'm playing someone here. If I see a company paying an IR firm and doing a bunch of essentially advertising to investors, that's like almost a red flag, because we're already looking for great values. We don't need to be sold on it. What would you say to that?
Yeah, I would answer that first and foremost by just saying that there are a significant amount of publicly traded companies on the stock market right now. Most of the attention is placed in the top 5% of the companies, the Googles, the Amazons, the Facebooks, the things. We all know the fan favorites, and I think Benzinga, particularly does a good job at covering a lot more of the kind of small cap, mid cap companies. And I think there's a lot of really exciting stories and companies in that category. I think that one of the things that we ultimately help want to achieve is creating more awareness for these companies. And the reason that companies should be leaning into it, and to your point about the red flags of companies that are hiring IR teams, we see this as an investment in marketing. This is a marketing investment, and while it might be overseen by the IR team, this is typically a campaign or an initiative that runs across a variety of different marketing channels that already exist. Most of the companies that we are working with are typically consumer facing, or there's some type of customer. Obviously, there is a customer, but they're generally understood so that we can really show the impact of the work. But I would say, Eric, the RCI CEO, he gets some flack on Twitter. And I think, at the end of the day, he's been told time and time again by the folks that have been, the bankers and the equity analysts that either, hey, like, you're too small for us to cover, and that way he can't even tell his story to that community. And ultimately, he looks at Twitter as just another distribution channel. I mean, like the public company CEOs and their management teams spend a significant amount of times in closed door meetings, meeting with these investors. And, ultimately, we want to just build transparency around that by making the executives more available to the retail community. And if that takes a little bit of time and money, I mean, we like to think of it, and our clients like to think of it as a worthwhile investment.
And another thing too is that if you're looking at it from the perspective of, okay, you're seeing us publicly active on Twitter for a company, money is being spent for any publicly traded company, like I said earlier, on average $800K a year. What we're able to do is come in at a lower price point, whether we're working as a public facing communicator or we're behind the scenes, which for some of our clients that we're not naming right now, we work behind the scenes with that, grow their socials organically through our creator network, all behind that. But there's money being spent. And for us, we're able to really track based off of social mentions, based off of volume traded when we do an event to really see the real world impact of this. And for RCI, we've been able to see new shareholders come in, top 30 shareholders, 7-figure amounts, all because of the efforts that we put forth. And so it's not going to be everyone's cup of tea, obviously, but nothing in life is. And, if you try to please everyone, you're going to please no one. So we're here and we're ready to make a big impact.
Mm-hmm.
Yeah, and I mean, that's why I brought that up, kind of, jokingly playing like the dumb, because I see that all the time, like on Twitter in the chat here, where someone like who thinks they're being really smart and they're like, like, why would I want to buy that? Like they're paying for this IR, like, and they think they're really doing something. It's like, no, dumbass, like turn on a TV, like Apple still has iPhone commercials. Like obviously, like, it's like part of the business, like what you do. You want to make sure
exactly.
you're
100%.
going.
And look, and from our experience, my experience in the advertising background, like we fully understand the FTC compliance issues as it pertains to making sure that all of the advertising is compliant, and also with FINRA and SEC compliance. Like Mark had to read the entire kind of forward-looking statements. He's probably memorized it at this point. He'll be reading it again on Tuesday when we help host the third quarter RCI earnings call on Twitter Spaces again. We hope to see you all there. But we're very cognizant of that, and we have advisors and other folks around us that help make sure that everything that we're doing is above bar, and that we're always maintaining compliance. And we look forward to also forging partnerships with the regulators over time. And ultimately, a lot of the folks that we're working with, Mark mentioned, Gary from who was helping Marvel back in the day. But there's a lot of really important meetings that are happening between the policymakers at the social networks and the SEC. And we want to ultimately help be in the room to help craft a lot of those regulations, because we want to ultimately help create a strong community that's accountable, and that's everybody knows what they're seeing and not being sold something that's being kind of a fake out. So we very much want to be above all of the nonsense.
Yeah, and last thing I'll say on the regulatory front is, so we had 10 SEC agents in the the second quarter earnings call for RCI. So we're very aware of the regulatory scrutiny. I'm a lawyer, so we definitely heed that and put that as a priority. But also, too, one thing is, for every firm we work with, we blacklist ourselves and everyone we're working with for this, because I can't wait for the day someone on Twitter comes and says, "Oh, you're pumping this stock," and then we say, "Well, actually, we're blacklisted. We're not." Right. So that's going to happen at some point in the future. But we've thought through all our defenses in advance.
There you go. That's that. JD coming in handy there. Mark, Brian, a pleasure to get you on today. I'm excited to kind of follow you guys as you guys launch this, see what's next for Equity Animal. Happy to have you guys on whenever you guys have developments or any news you guys want to share. I'll go ahead and drop that URL as well as your socials in the chat one more time. But thanks again for hopping on today.
Perfect.
Yeah, we appreciate the time. And for anybody watching, if you're at a publicly traded company and you think your IR work is due for an upgrade, you know who to call. Thank you, Aaron and Zinger Nation, for having us, and we look forward to seeing you soon.
Thanks, AB.
Of course. Yeah, of course. Always. We'll be in contact. All right, guys, that was Brian and Mark Moran from Equity Animal. Let me go ahead and drop that URL in the chat, as well as their Twitters if you guys want to check that out. New IR firm aimed at retail investors. Hey, that's us. That's us, guys. And then, guys, we've only got about 9 minutes left on the show, so let me stop blabbering and let's get our next guest, Options Mike, on, because he's been patiently waiting in the background. Let's give Mike our special. Mike, how's it going?
Aaron, how are you, man?
Pretty good. Cannot complain on this beautiful Thursday.
It is Thursday.
Been a few weeks since we've had you on. What you been watching? What you been doing? What you been up to?
Been trading my ass off. How about you?
I haven't been. I've been honestly been trading less recently. I mean, it's probably partly because my account's not doing too hot. But yeah, I haven't been trading as much.
Less has been more. I've just been finding the right trades and working really well. And I love earnings season because it gives so much opportunity. You have names in play. And, Aaron, I know we don't have a lot of time. There's so much negativity on this market. And, I've been saying for weeks this market's changed characters. And it really has. Bad earnings, doesn't care. Bad data, doesn't care. And everybody's like, the sky is going to fall. And you know what? They could be right. Well, nobody really knows. But man, the trend right now in this market is up. It's finding strength. It's holding in. You're getting a nice day of rest here, which was what the market needed. We take out 417.44 area in the SPY, and I think we're shooting up to the 200-day relatively quickly up into 432 area.
Wow. What was that first level you said we had to clear?
417.44. If you look on a chart, you can see we flagged there. And
do you mind pulling your chart up real quick?
It should be up. Can you see it?
Nope.
Let me fix that. I had it up. Must have come down.
All good.
Here you go.
We want an hour and a half shirt. We do an hour and a half. We've been live for an hour and 33 minutes right now. We started at like 11, or we started early today. But yeah, sorry.
See, you can see up here, this little area where we bounced last time and we created this range. This is your big area. 1470, 417.44 is the top of the range. You take that out. Here's your 200-day up here. You notice you're trading this really wide descending channel. So there's a lot of room for this market to melt up. And, you know, we don't have a lot coming at us for the next month. The majority of earnings are over here. They bought back every name that had bad earnings. They didn't care. Freaking Roku, one of the worst earnings report and guidance I've ever seen in Shop. And they're both pushing. Shop's above where it was, breaking out of its range, and Roku's coming back. So right now, this market's in melt-up mode. We don't have the Fed to September. This market can rally a lot longer than people realize right now if it wants to, on very low volume.
Yeah, and I think that's what we're seeing. Do you think that's why? Because there's more short interest right now.
Well, you have a lot of people short. You have the dog days of summer, right? This is when volume drops off. Most of the big traders are out in the Hamptons. They're not paying as much attention. Earnings season's over. You don't have to worry about the Fed. And it's typically a quieter time in the markets. And right now, the path of least resistance is up. Like you said, a good amount of people still short this market and easy to squeeze them. And markets are melting, and it's being led by big cap tech. And this is all you have to know is when you look at the names leading, you got Microsoft broke above its earnings high, right? Pushing up nicely here, working its way back up. You have Apple, which has had a huge move. So you're not being led by bad companies. You're being led by great companies. Look at this. Here's your earnings move. Then yesterday you had this big breakout candle. And, right now we have to clear this level here, right around this 166. That's a big spot. But above that, then you look for a move up to 170. And, again, look at the bounce on this, the strength. AMD today, after they didn't want it after earnings, is absolutely raging, right? Raging today. Brought it all back and then more all the way up now. You can see it's coming into this volume shelf area.
Yeah, I mean, how about AMD, like you said, after earnings? What about Airbnb after earnings? Airbnb reported, a disappointing quarter, dropped 10%, and all you had to do was buy it after the drop, and you're already back up where we were pre-earnings. Like we've digested the earnings report, filled that gap, doesn't care. We're back to where we were. So,
Airbnb, I went through the report and I read what went on with them. And honestly, I couldn't find a problem with that report. They turned a nice profit. They had good, there was a good report. They guided well, and they're doing a $2 billion buyback. Now, I don't like a $2 billion buyback in a company that is still going back and forth between profitability and losing money on a quarter by quarter basis, because you have to borrow to pay that back. But the only thing I could fault them is their growth forecast just wasn't enough for a growth stock, but they're buying it back. So it looks like, this market's really strong. If you look at Airbnb, you have this huge volume shelf sitting here at 124. You get above that, look at this. You have this big void. It can easily jump up to 132 pretty quickly. And, so everybody's negative on the markets. Well, okay, be negative on the markets. I've been trading to the long side. And until we break the 8-day in the SPY, Aaron, I have no interest in trying to short. You have very low volume here. And a lot of what you see here are algos playing games. They're going to come in. They're going to yank the market for 10 to 15, 20 minutes just because they want to stop out everybody day trading, then bring it right back up. And the biggest advice I keep selling in my room is if you're in options, avoid weeklies, take time, go a month out, because then you can get through these little gyrations without a problem. If you're in weekly options, you're going to get freaked out, you're going to get stopped out, and you're going to be having a harder time because they're decaying fast. They're working against you.
Yeah, and I don't know, like, I get it why people are out here, buying puts and thinking the market's going to downturn. You might think we're overextended, but like, there's just so much strength out there. Like, the trend is your friend. And I was talking about this the other day with some of these crazy runners that we've had the past couple of weeks, like HKD, some of these different, monkeypox biotechs that have been up 100% or something. It's like, if something's up 100%, I'd much rather bet that it's going to go up another 100% before it just comes straight down. Like, it's really easy to see something be up and be like, oh, I'm going to buy puts. But chances are, and what typically happens is they keep going up for a little bit before then they come down.
Yeah, but I think, in my opinion, more importantly, you have big quality tech names leading. We haven't seen that in a while. NVIDIA's breaking out. I think that's the sign of a stronger market. It's not these little guys, right? You're talking about these monkeypox plays. HKD was just a farce, right? No volume on that thing. That thing trades a couple 100,000 shares a day. But, you want to gamble, that's a pure gamble. That thing. I wouldn't touch that with a 50-foot pole. But, the market has strength, and I get it. You want to be negative. The macro hasn't changed. No, but the market at this point is saying it doesn't care about the macro right now. So until it does, you don't either. And if you want to just blindly short the market for no reason, have at it. I'm staying nimble. I'm staying long-minded, and yeah, it's been a great last couple of weeks with that.
Yeah, the volatility has just been insane, and I mean that's just where I stand right now. Is it's like if someone had asked me, gun to my head, bullish or bearish, I'd be like, well, we've been going up, so I'd say we're gonna keep going up until we're not, right? You have that inertia. The trend is your friend.
The VIX has been smashed, right? The VIX is absolutely smashed back down. So I don't know what people want. I don't know what people are looking for to feel any kind of bullishness in this market. And you know what? That's sometimes how these rallies keep going, because people are so bearish, it just feeds into itself. The more bearish they are, the more people keep pushing them up and make them cover. But I know we don't have a lot of time today, but yeah, that's my thoughts here.
We are running out of time, so we'll have to leave it at that for today. But Mike, we'll have to get you back on next week or sometime soon when we have a few more minutes, because like I said, it's been too long since we've had you on.
Thanks, Aaron. Catch you next time. Thanks, guys. Benzinga.
Of course. No problem. All right, guys, that was Options Mike. Let me go ahead and drop his Twitter in the chat so you can give him a follow there. But we do have to wrap here in about a minute. Stock market movers with Money Mitch will start at 1:30. He will be talking to Mullen CEO. I know we have a lot of people here in the chat here for that reason. So here at 1:30, David, let me get his last name right. David Mishery from Mullen Technologies will be on at 1:30. Money Mitch will be talking to him, so do not go anywhere. This stream will automatically redirect you to that one. What do you mean, no, AB? We got to wrap. I'm sorry. What else do you want me to do? Till tomorrow. Love you guys. Not AB. Luke, Mr. Luke will be on with us tomorrow. Luke and AB together at the same time tomorrow. So stay tuned. Love you guys.
This